Have you ever looked at the stock market and thought, how is this thing still going up? Every warning light is flashing. Debt is rising, prices are high, and the economy feels shaky. Yet the charts keep climbing. Today, I'm going to walk you through the real reasons the market hasn't cracked yet, and why the delay might be the most dangerous part of all. Not doom, not hype, just a clear breakdown of what's quietly holding everything together. If you only looked at the usual indicators, you'd probably expect the market to be in freefall right now. Consumer debt is near record highs. Savings rates are near record lows. Companies are warning about slower earnings. Valuations are stretched far beyond historical norms. On paper, the market looks like a rubber band pulled to its absolute limit. But markets don't fall just because conditions look bad. They fall when the things propping them up finally give out. Once I understood that, everything clicked. The weird disconnect between the headlines and the market actually moving made sense. Let's break it down. One of Warren Buffett's favorite long-term indicators compares the total value of the U.S. stock market to the size of the U.S. economy. Basically, market cap divided by GDP. Market cap, roughly $66 trillion. GDP, roughly $30 trillion. That ratio comes out to over 200%. For context, before the dot-com bubble burst in the early 2000s, it was only around 115%. Today, we're nearly double that level. Then, there are price-to-earnings ratios, and this is where things get unnerving. Historically, the S&P 500 trades around 15 to 16 times earnings. Today, we're sitting around 25 to 28, even higher in some sectors. But the real concern isn't the index. It's the handful of mega companies pulling the whole market up. Nvidia, 50 plus. Amazon, mid-30s. Microsoft, upper 30s. Tesla, well over 200. It's like paying $40 or $50 for every $1 a company earns. People do it because these giants dominate the index, but it's stretched. And historically, stretches snap. So based on valuations alone, you'd think the crash would have already happened. And yet, here we are. Let's talk about the forces quietly holding everything in place. Two major forces are keeping the market inflated far longer than people expect. Force number one, quiet, ongoing government stimulus. Most people think stimulus ended years ago, but spending never actually slowed down. The government collects around $5 trillion, yet spends closer to $7 trillion. That extra money flows into companies, wages, contracts, and social programs, which eventually flows into consumer spending. That spending boosts company revenue, which boosts earnings, which boosts stock prices. It's not labeled stimulus, but it acts like one. The catch? The government is carrying over $38 trillion in national debt and over $1 trillion per year just in interest payments. That kind of spending can't run forever, but it does hold the economy up in the short term. And force number two, a weekly weakening dollar and persistent inflation. Here's something that surprises people. A weaker dollar often pushes stock prices up, at least for a while. When the dollar loses purchasing power, companies raise prices. And even if they sell fewer units, the higher prices make earnings look strong on paper. Inflation disguises itself as growth. Meanwhile, the supply of dollars keeps rising, which pushes the value of each dollar lower. As long as inflation stays elevated, assets, including stocks, appear to climb because their price tags adjust upward. And big investors know this. Many borrow money to buy assets because inflation makes their debt cheaper over time, and the assets they bought tend to rise in price. This combination quietly keeps the market afloat, even when fundamentals are flashing warning signs. A lot of people assume markets crash the moment bad news shows up, but that's not how it actually works. Markets crash when confidence breaks, not when data looks scary. Right now, confidence is being held together by three very fragile threads. Thread number one, consumers are still spending borrowed money. The U.S. economy runs on consumer spending, almost 70% of GDP, but savings are low and credit card balances are exploding. This can't continue indefinitely. Thread number two, the labor market looks strong, but it's lagging. Hiring has slowed. Layoffs are rising. Fewer job openings mean less spending power. The job market usually weakens after other indicators, not before. Thread number three, rate cuts don't have the same power they used to. In past cycles, lower interest rates boosted the economy. But today, debt is high, costs are high, consumers are tapped out. Lower rates can't magically fix those underlying pressures. When these threads finally snap, confidence goes with them. Every major crash in history follows the same sequence. Phase 1, markets stay high longer than makes sense. We're here now. People are confused because the market feels disconnected from reality. Phase 2, bad news stops scaring investors. This is called crash fatigue. Everyone hears recession headlines, layoffs, rising prices, and shrugs. That's actually one of the most reliable pre-crash signs. Phase 3, a single event breaks confidence. It doesn't have to be dramatic. One bankruptcy, one big earnings miss, one credit event. Something small lights the fuse. Suddenly, the sell-off everyone expected months earlier arrives. Fast. The delay isn't a sign of safety. It's the pressure building before the release. The market hasn't fallen because it's strong. It hasn't fallen because two temporary forces, government spending and inflation, are holding it up. And when those forces weaken, the market won't glide down slowly. It tends to snap back to reality quickly. This isn't about predicting doom. It's about understanding the mechanics so you can stay calm, informed, and thoughtful when other people react emotionally. If this breakdown helped you make sense of what's happening, hit that like button and subscribe. We post simple educational videos every week to help you build financial clarity and confidence. Thanks for watching, and I'll see you in the next video.